good morning. You're watching the market right here on 80 now, and it's all smiles and joy across the newsroom and the studio as well. What a magical move yesterday.
Magical move which has promised to sustain, and for large cap stocks abhi to party shuru hui hai.
Absolutely.
This is normally when you see such a powerful move you always feel that okay, how much more. Yeah. But I think for large cap stocks, that big turn which we've been waiting for, finally we are at that turn where acceleration will happen. Now it's very easy to look at the market and say okay, the run up has been too fast, too swift, there's too much of euphoria, it's not the time to buy because everybody is just everyone is on the same side of the board. But no sir, I think based on what conversations I've had with everyone and my understanding purely based on what I've tracked over the years is that I think we are at the beginning of a big turn in some of the large cap stocks. In the month of November, what did we see? We saw a global rising phenomenon from Bitcoin to gold, from emerging markets, from India to Europe, everything moved up in a synchronized manner. December, I think it's evident looking at yesterday's price action and last week's price action that Indian markets now are likely to outperform, and they are likely to outperform independently of what is happening in the world. So I think we are in for a good patch for large cap stocks. We'll talk about it, that what should one do with small cap stocks, but the setting on the table is very simple. Whether you call it FOMO or whether you call it compulsion or whether you call it the obvious move, it's time to say hello to FIs again.
Absolutely, because yesterday's price action, like we've been highlighting, was not really restricted to what the Nifty was doing or the Nifty Bank was doing. Broader indices, of course, they continue at live highs, but the Nifty Bank as well has seen the biggest one-day gain in about a year's time. And guess what? The contribution within the Nifty Bank actually came in from the laggards, the big boys which haven't participated in the rally so far. So it was the likes of Kotak Bank, it was ICICI Bank, and it was HDFC Bank. They were the ones which continued to hold out, and they were the ones which pulled us up to the life high, or rather to the intraday closing high as well, that we clocked both in the Nifty Bank as well as the Nifty. While PSUs, Adani group of names, the broader markets, they also continued to hold out.
So Aisha, you got to ask yourself, okay, the rally in large cap stocks is evident. Yeah. So do you invest fresh capital, or it's time to change gears? My sense is that if you rotate out of small and mid cap stocks, let's say 15-20% of your allocation back into large cap stocks, I think that would be a good idea. Yeah. This trade is not going to hurt you. It's not going to hurt you. Looking for that word. This trade is not going to hurt you. And I'll put some simple data point here. We've discussed this data point, but the data point is just based on valuations. Large cap versus mid cap and small cap versus mid cap. Small and mid cap stocks are now trading at a massive premium to the historical averages. For large cap stocks, that is not there. What makes me bullish about large cap stocks is that even though the narrative is strong and supportive, global narrative, the trend and momentum, the liquidity, but valuations are not stretched, which means the case for large cap stocks to move higher, I think, is evident. And this is at a time when foreign institutional investors are not there. In small and mid cap stocks, I think it's the other way around. The run up has been strong, the frothiness is visible, and valuations in some cases are really out of whack. So if you have to have approach, I guess the mindset has to be bullish. The approach has to be book some profits out of mid and small cap stocks, but stay invested, because these are times when you just jump off the bandwagon, then you will not really be able to enjoy the true blue benefits of compounding and of a bull market. And well, what can I say? Mr. Bull, Mr. Maverick, he is ready. He's joining us from Dubai. Good morning. What is the time in Dubai? We managed. Are you sleeping? Subah subah utha diya.
6:35. No, I get up at 5:30 everywhere whenever I go.
5:30, and then what do you do after that? You watch ET now?
No.
You watch ET
in
now.
Singapore,
Come on, say that you watch ET now.
Yahan pe no walking. Yahan pe getting ready for you. Subah.
Okay, our markets, our large cap stocks getting ready to do a tango now.
Yes, and that we've been saying for long, simply because if you look at the performance of mid-cap stocks say from 2000, I did on Bloomberg a few days ago, 2000 to 2019, let's say, before this COVID and all, then there was not a very big difference between the mid cap index and the large cap index or the small cap, small cap and mid cap I did. And then suddenly from 2020, if you start from March, the difference is something like 25% per annum over 2 years. So these things, we know broadly that all their life, these things in the end revert to somewhat similar. The mid cap is, I think, about half to 1% higher in normal long duration. So this is obviously extreme. And we know broadly that the big stocks, some of them which have been doing well otherwise. For example, if you look at the large stocks, there's the consumer guys, the levers and all those types. Then there's the IT guys, and then there's the financial guys. So broadly, we believe that the financial guys have actually been delivering and they have not gone up. So they shall outperform, is what we hope and pray and position ourselves for.
We were looking at the positioning of the market, Sameer, and the positioning of the market in the month of November has been that it's been a global rising tide phenomenon, from gold to
Correct.
Bitcoin, from emerging markets, so everything has
US.
gone higher, right?
Yeah.
Do you think now we are on the cusp of what could be called as the real outperformance, India outperformance?
Actually, this year, India itself has not outperformed at all, actually, if you compare basically with the US. But over time, it has. And when we do that, every day we look at it and say, we look at overnight trends or overnight this thing from which market has done what. But over time, you can see that consistently India has outperformed. Not US in the last 5-10 years, but it has outperformed US also, but broadly in line. But over 20 and 25 years, it has outperformed everybody. And over 5, 10, and 15 years, it has outperformed everybody other than US. And US only a little bit, it has outperformed, I think. So broadly, what I mean to say by that is that day to day, it might look that all markets are going together, or even, say, if you look at November. But over time, India has done well, and there is no reason to say that that outperformance will stop. In fact, it's more likely that the US outperformance will come down a little bit because they have had a very big 15-year bull run post 2008.
Sameer, hi, morning. Let's also get in a take then as to what you believe is going to be the outcome when it comes to individual pockets, in particular those PSUs that have really fired up hard and smart, in fact rallying the most for the PSU index since the year 2009. Do you think that the party is over here, or there's still more to go?
Well, we have some of those stocks and we are happy with those. We are not expanding our PSU thing on the basis that BJP is coming back, because it is not clear that they are going to do anything particular about many of them. We own a few now across our portfolios, including State Bank and HPCL, which has been our new big discovery last few months, and one or two more. But broadly, we are not going in helter-skelter into PSUs because there is no such logic that these are to be privatized or something has to happen to them, particularly just because the government is BJP. I don't think mean that PSUs have to do bit different from others, but they have done well because they were viewed as being cheaper. But over time, I am a 28-year player in this market, and some of these things only last in phases. Now, some of them may do well beyond that, but broadly, my thumb rule says you don't have to blindly go in just by the label.
Sameer, I mean, I know India has always been a stock-specific market, and it would continue to be, with, of course, brief pockets of blanket sectoral or thematic outperformances. But has the time come to tactically move a higher allocation towards large caps, underperforming banks, etc., what have you, as opposed to mid and small caps?
By the way, India has, within India to outperform, you needed to be within, this stock or that stock. But India as a country has outperformed over, as I keep saying, 5, 10, 20, and 25 years. It is number one in the world in US dollars, and in over 15 years is number 2. Now, coming to within India to try and outperform that index, I think large caps will do well, because it's easy for new investors, particularly foreign investors, who are looking at India seriously, not only because India is doing well, but because they are getting bugged out of shape in China. And I think I spoke to you guys about my visit to Tokyo, where the number of meetings was like 2.5 times what I would normally be able to have at a hedge fund conference. So that money, when it comes in, will it's psychologically easier for them to buy stocks if somebody says that, even though the market, you feel you have missed a little bit or a lot. Actually, I keep saying you have not missed a lot. The larger cap financials is the easiest to buy. They're also a large part of the index. So even if these guys underweight, overweight, they still have to put, if not 30 odd percent, then 25%, but all that has to go into the same large cap names. And within those three groups, which is financials, consumer, and IT, it is easiest to buy financials because they are doing well and the stock prices have not done well. And then there is IT, which is not doing well and where the stocks have actually done well this year. And then there is consumer, which anyway is more difficult to buy because they are always on paper looking expensive with normal growth. I'm talking about the big consumer guys.
Fair enough. That's really the strategy that you believe one should adopt. And what about the liquidity situation? Because I'm just mapping out the 4-month FII data, and after quite a big chunk of selling in the months of September, October, and as we've seen in the past, November brought in the FIIs. And do you believe that with the kind of election outcome and the kind of macro setup, that the FIIs will only continue to look at the Indian story positively?
Well, they've always looked at it positively, except the last 1.5 years. So again, let me tell you, over the last 20 years, there have been only 4 calendar years when the FIs have been net sellers, and these were 2008, 11, 18, and 2020. And last year, 2, not 20. And even 21 was, second half was very bad, but overall was sort of still zero type of number. So they have sold for, say, they sold before this year for about 18 months, some $35-38 billion, which is about 5% of what they held. And the market has gone up, so they have not really lost anything much significant in that selling also. So generally, everybody is a buyer every year. Now, the question is, will you be a disproportionate buyer? And I think they will be disproportionate in India because of the space created by them not going into China. China's weight is about 30% of emerging market index. India is about 15. And then you have Korea and Taiwan, which look very similar to China. So if somebody is not investing in China, they are not taking that money and buying Taiwanese stocks with it. So basically, if they reduce a little bit of China, which they are all doing, saying, clearly giving in interviews, that money just natural home is India. If India continues to do well, both fundamentally, which it is, and also momentum, so that they feel every day the pain of delaying their decision. We are betting on that these guys will come back with style. But they've always been investors except for these 4 years, and people only remember the last year, particularly to say that FII buying is something new. It is not new. It has always been around in a big way.
Samir, I have simple data point here, and I'm sure you're aware of this data point. I'm just bringing this data point out for the benefit of our viewers. In last 4 election cycles, Samir bhai, markets have seen a run-up into the elections, which is that 6 months prior to the election, markets have run up. However, if you look at 6 months prior, there is no uniform data which can be established. So do you think this time it will be no different?
You mean to say after election, it is not clear?
Yeah,
before election,
before election, they've always run up. That data is there, it's widely been discussed. There's a pattern.
There is absolutely no need to think today about what we will do from month 7 to month 12. Let's enjoy 1 to 6 now, where you say it does rally. So let's do that, and then we'll see how far it has rallied and which stocks have rallied. So, for example, leading up to 2014, we were all very bullish on the market. But after the elections, if you saw that the PSU stocks and all those didn't do well, but the rest of the market continued to do well. So we'll see again what has happened by the time elections are there, that how much hopes have we built in on the market, but more than that on specific sectors and what logic we can draw on policy connections with that. So we'll see. So right now, let's not worry what will happen post-election, which are still 5-6 months away, or 5 months away at least.
Samir, is it intriguing that, at a time when, yes, sure, Nifty is doing what it's doing, as are US equity markets. We all know how the Nasdaq has beat even what the Indian equities have done. But at the same time, you've got gold also at an all-time high, and Bitcoin is also back to 42,000.
So in some sense, I think people are building it that the interest rate cuts in US will be significant. Number one, I don't think they'll be significant because there is no need for them to be significant right now since the market and the economy there are doing well. Actually, the US GDP growth was what 5.9% or something, giving them time also to correct their excesses. And therefore, I think they will stay higher for longer, but definitely they're not going up more. And there will be some cuts sometime in the 2024 calendar year. Regarding gold, which I actually own reasonable amount in my personal portfolio, some 8-10% of my portfolio. Broadly, I used to think that these high interest rates won't help gold, and I was getting ready to sort of sell it off, but then realized that these US depreciation expected and also these geopolitics and all means that gold should actually be there for long, forever. I have held it since 2008 or 7. That actually it is supposed to be bought and forgotten. So let's see.
कि 90% पोर्टफोलियो क्या है?
90% में 60-70% equities है, 20% अभी US proportion में से cash वैश में है.
If you have to talk just one simple advice for those who are saying that there is bubble and trouble and a mania in small cap and mid cap stocks, how would you address it? Because that's
in some stocks there would be. In some stocks there would be, because first of all, the small caps are so many stocks. It's easy to say that some stocks are very good and some stocks are, still maybe fair value, reasonable value, whatever, or doesn't look a bubble. But yes, overall hype, if you see, yesterday our NAV and everybody's NAV went up 2% and beyond, but it was a bugging day in terms of the tweets and how everybody talks about his one stock having gone up. I want to see all these guys do it over 3-5 years, forget about 10 and 20 years. These things come and go so fast that every year a new guy's tweet will come saying how his 3 stocks have done well. It is a tough game. And therefore, in this kind of a market, or actually in all kinds of markets, you should be clear what you are buying. So how am I able to hold on to an HDFC or an ICICI which hasn't done anything for 2 years, while there's an HPCL which is up some 40% in a month, is because you must know what you are doing. Every stock is not supposed to go up every day. Some stocks are there because they will over time outperform the index, but they will not outperform every day, but they will not perform by a big number, which is what we call high confidence in reasonable return. This is required because there'll be months when for some unrelated reason the market will be down 5-10% and the small caps will be down 20% and you will panic out of your mind. If you don't believe this, see the number of people who started their journey 10 and 20 years ago in the markets or as fund managers and see how many of them are the same. Maybe 10%. You don't want to be the 90%. Just be cool. And actually, the young guys should not be so excited that the market has gone up and is going up this year. They have not even started their journey. Even I feel sometimes that, oh God, I have 10% cash and I have 3% in one fund. Why did the market go up so much? And this I'm doing with a close sum of money. These fellows have to save for the rest of their lives and they're getting excited that on the day one, the market will be up. Over time, the market is not giving up more than 15% annualized. You can do what you want. In the beginning, if it goes up, it will be taken away in the end. You want it to be slow and steady so that you can invest a higher proportion before this thing happens. Otherwise, if it goes up 30% this year, you can rest assured next year, that is the following year, it will be up less than 15. Just chill. Just enjoy the ride, which is for 5 years and 10 years and 20 years. And don't get so excited about tweeting one day's return of one stock that you may have bought in time.
Absolutely. But that FOMO feeling, that's more real than one can have,
No,
one
FOMO
can
feeling
ever
should
think.
be there. FOMO feeling should be there to invest for the long term. Because you will make more in equities than you will make wherever you kept your money. Wherever you've kept it, where you're feeling the FOMO, that feeling should be there. But what I'm saying is, don't hope and pray that the whole market goes up in 6 months only before you've had invested a major proportion of your future income. You actually want the market to go up steadily, which actually it never does. So it's not that I'm saying that it ever does that. I'm just saying, just enjoy the whole ride rather than a day at a time.
I guess just chill, just enjoy. That's the message then from Samir. I hope you're doing exactly the same when it comes to the stock markets and even in Dubai. But thank you so much, as always, for joining in and sharing with us your take. All right, that's the word coming in from Samir Arora. Time to connect with our chartist, Nooresh Mirani, as well as Kunal Bothra. Nooresh, Kunal, rather, are you chilling at the current levels, 20,600, all-time highs, fierce rally across the board?
Well, I think it's been a good market over the last, I think, one and a half odd months from the October 20th October lows. I think from there specifically, we've seen a very strong, vibrant market throughout the last 2,000 odd points for the indices. Now that we've managed to surpass the 20,500 mark, and there was some sort of short covering on the index futures, as well as put writers trying to initiate a fresh stance at the 20,500 puts. I would believe that that could act as a strong support for the index over the near term. So the bias remains bullish on the indices. We are now expecting a higher momentum or a higher degree of momentum on the Bank Nifty, and I think that's one index to be watching out for.
Okay, talking about the Bank Nifty, Nooresh, have to address what the likes of Kotak, HDFC Bank, ICICI did, the trio that is. You think they will continue to chug along the way they did yesterday?
So expecting actually say some of the names to take a much bigger trending move. So if you look at it, HDFC Bank continues to be the largest weight, almost 29% of Bank Nifty. It's come back to fill the gap, which it saw a gap down in September. But at closer to 1650, 1670, it has a big multi-year resistance now. If you look at the last 3 years, the stock was at closer to the 1650 top back in November 2020. And over the last 3 years, that has been a stiff resistance. So I would expect a move towards 1650, 70 and then a pause. Then going to ICICI Bank, that becomes interesting because that's the second largest weight. And yesterday's move was a strong one. It's got it in touching distance of an all-time high. So if you look at the highs in the last 6 months, there were 2-3 highs around that 1000 mark, 1010. And at 990 close, the stock is pretty close to an all-time high breakout. If this can continue beyond 1000, 1020, then it creates a fresh trend wherein it has much larger upsides. So expecting ICICI Bank to get back into leadership like it was back in 2020-21. Kotak Mahindra Bank, very similar to HDFC Bank, has a bunch of resistances around 1900, 1950, 2000 levels. So I would expect, say, a maximum bounce towards 1900 in this move. But overall, expecting a new leader, which is ICICI Bank, to have come back. And then we'll be watching out for SBI, which again has a similar resistance around 600, 620.
All right, let's nail it down to those individual stock calls. Kunal?
So I'll bet on a couple of banking names, larger cap ones. ICICI Bank is the first stock which I would suggest as a buy. The stock showing excellent momentum yesterday. So targets of 1020, 25 over the short term. Stop loss at 975. And Kotak Bank is the other name which is completing an inverted head and shoulder pattern on the daily charts. So targets of 1880, stop loss at 1780.
Nooresh, let's get in your recommendations this Tuesday morning.
So first is a buy on Federal Bank, which is the best performing mid-cap banking name, closer to an all-time high now, just a percentage point away. 4 or 5 attempts made around this 150 to 155 mark. Seems like a breakout is in play here. Stop loss at 148, target price of 180. Second is a buy on IndusInd Bank, which is still below the pre-COVID prices and has started to make a recovery. Came very close to the short-term 52-week highs. Expecting a follow-up move towards 1650, stop loss at 1470.
All 4 picks from the financial space. Thanks, guys, for running us through your top recommendation. Stocks to watch in trade, and Anisha Jain's right here with us in our studios to discuss that. Let's discuss M&M Finance then first up with respect to their latest business update and what the brokerages make of it.
It's a bit subdued, one would have to say, because on a month-on-month basis, the disbursements are pretty much flattish. The AUM has also remained flat as far as this month is concerned, close to 96,600 odd crores. Remember, the base was also high because October saw those festive demand coming through. But you put together October and November, and then you will see that the total disbursements are up only 8% year on year. And I'm saying only 8% because the quarter before that we had seen a growth of almost 15 to 20% on disbursements on a year-on-year basis. So from those 15 to 20% growth levels, it's now down to sub 10%. So 8% kind of versus what we have seen in October, November. So this is the trend that we are witnessing right now, and the brokerages are not very enthused. For now, Morgan Stanley says it's sluggish numbers. There are downside risks to the forecast. While the disbursements were in line with expectations, if the growth does not pick up, there is probably a risk to the AUM forecast going forward. The collection efficiency has come down a tad bit and the asset quality was range bound. Jefferies also says that they're maintaining hold on the stock with a target price of 295. The valuations appear reasonable. The visibility on trajectory for higher ROA is what they need to drive further re-rating on the counter. So overall, for now, it's not a kind of update that has come in which will warrant a fresh buy. But would it warrant a fresh sell? What do you think, Nikunj?
See, the stock is cheap in terms of price to book. So obviously, in a bull market, if you underperform and if the stock is not, if you don't deliver and the stock is cheap, the downside will get limited and restricted. For those, it is not like the darling of the market. It is a stock which, in a sense, has disappointed consistently in terms of delivery and in terms of performance. I mean, it's a Mahindra Group company where the entire group has changed complexion in terms of delivery. But Mahindra Financials, I think, has been an underperformer within the category and for the group per se. Now, we know that there is going to be change of guard soon. So maybe markets would give the stock a benefit of doubt. But, at a time when everybody is going to rotate out of banks, NBFCs into banks now, I think NBFCs otherwise are expected to underperform, and I think the evidence was there yesterday when Bajaj Finance, L&T Finance and Indiabulls Finance. So NBFC per se are likely to underperform. Within that, a weak stock I think will remain a ranked underperformer, but the downside would get only limited and restricted because of valuations and hope for a change of guard. I mean, they've not been able to fix the problems which they should have done it despite the lineage of Mahindra Group. Attractive cost of borrowing, great brand, great distribution, but the collection efficiency is poor, the disbursements are difficult, there's so much of volatility in the number that for a business which could have been a steady compounder actually has behaved like a commodity stock.
And Anisha, with every massive uptick in the market, we all look forward to Lawrence Belanco's note. What's the level he's now pegging out?
Well, he's opened the level of 23,000, so that's something interesting. So on the upside, the targets immediate are 21,200 and 21,300, but he is talking about that in the medium term, 22,800 and 23,000 levels are possible. More importantly, I like the commentary wherein he says the recent uptrend is actually signaling the resumption of the original breakout. 2021 to 2023 was a bit of a consolidation pattern. We are breaking out of that and there's a resumption of the uptrend. So that's the positive cue coming in. He says the Nifty continues to work its way higher following the breakout that has been seen above 50-day moving average. The US dollar terms, the Indian market share in the MSCI, indices has actually gone up. Support, of course, he's around 19,200, 19,230. Doesn't look like, at least in the near term, we are going to test those levels anywhere soon. But there is a bit of a resistance around 20,980. So he's watching out for the time when we break out of 21,000. If we go by what GIFT Nifty is suggesting, we are likely to see those 20,800, 900 levels soon today itself. But the big question is that 23,000 is something he's talking about.
Kunal is the right guy to give a perspective on this.
Sure.
23,000 before March?
Yeah, very much possible.
Possible.
Yeah, and
23,000 sir is 2,000 points away.
What's the probability you will say? Possible, yes.
Yeah, and in a bull market, in a strong uptrend, it's never
Never
wise.
say never.
It's never wise to have a target or a top on the indices, because in a bull market, so for example, I'll give you an example. REC PFC, everyone thought that at 220 to 250 these stocks are overbought. These stocks went to 300, then 350, and now 400 for these stocks. So
people thought the same about defense names as well.
In defense stocks, there are so many sectors. BPCL, HPCL, these stocks were overbought maybe a week or 15 days back, and now these stocks have run up significantly high. So I think in a bull market, in a very strong, fierce bull market, you should never question. I think you should just continue to ride the trend.
No, Kunal, but the other chatter which I've been reading a lot on WhatsApp and Twitter is those RSI levels which are above 80, nearing 90. The fact that almost 95, 97% of your stocks in Nifty 50 are above 200-day moving average. No, is there anything to worry about that? That's the point.
Yeah, just chill. I'm saying, see, Anisha, we can get into this myopic kind of assessment on a daily basis and start tracking the market based on historical parameters. But bull markets of this ferocity are once in a decade phenomenon. So,
how do you distinguish them? Where do those technical indicators go if you don't want to take it?
If you are in for a one day, see, what has Buffett taught us? Buffett has taught us that markets can remain irrational for a longer period of time more than you can remain solvent.
So
And
they are
that's
irrational?
There are pockets which are rational, but they remain irrational much more. I mean, I can argue back and say, okay, this is the right P, that is the wrong P. But what has Rakesh taught us? That there is no thumb rule which says this is the right P and this is the wrong P. So that's the intellectual, argument. Maybe this is not the right time to get into it. All I'm saying is that you don't have to sell for the sake of selling. You don't have to be cute for the sake of, being cute. Let's understand the trend. Is the trend up? If the trend is up, then overbought can remain so overbought.
Exactly.
And you make time the market again and again. You will you'll sell, then you'll wait for the market to come down. Maybe market will not come down. In a bull market, maximum gains, more money is lost when you're waiting for the correction rather than the actual correction occurs. So the choice is yours. Be with the trend or try to be something different and then come back again at higher levels.
Yeah, and the underlying point, I think, what Sandeep
Just
was
chill.
making, that don't be in a hurry to try and calculate your daily gains. Participate in the market rally. That's all that matters. 15, 20 years, you will make phenomenal results.
Even in the short term, Aisha, the ferocity of the bull market in large cap stocks, when was the setting on the table so clear for large cap stocks? Attractive, FIs will come back, undervalued, good support from earnings, macros are on your strong. When you see a like this, then why do you want to have this fear of being a Cinderella? I mean, that happens in fairy tale of 12 o'clock that I have to get back early. So the Cinderellas of the world were thinking that bull market is over, take a chill pill. That's the point.
It's just 1 p.m. right now, so even if it has to be the Cinderella moment, it's quite far away from midnight. We'll take a very quick break. Anisha, thanks for highlighting all those notes. And when we come back, we'll have another market voice join in. Back with the market right here on ET Now, and this morning, of course, the Nifty implied open is indicating towards some bit of consolidation, but we're absolutely okay with that. It's really been a tearaway move that we've had on Monday, not just for the Nifty, which is now, inside of that 21K mark, but for the matter, the way the Nifty Bank as well participated, and of course, the broader markets, they continue to hold out as well. Who better than Sanjeev Bhasin then to celebrate this moment? Sanjeev, hi, morning. Good to have you on the show as always. And what a wow Monday it turned out to be. But a lot of FOMO feeling as well out there, right? People thought they were under participating in the move that one has seen, at least in the large caps. Give me 3 names, Sanjeev, where you can still buy.
Yeah, good morning, Aisha. Superb Monday and superb month. I mean, what a month. 1 month can make so much of a difference. And I remember 25th October was my birthday and I called a lot of people on the 60th and everyone was, doom and gloom. I gave them stock tips and I told them new highs are here. Nobody believed. But, so is the grace of God that India is in an outperform market and the biggest fools now are the biggest buyers. So that frenzy will now continue. FIs underweight will turn into medium weight and then overweight. But the real, proxy to this bull run is the retail investor. Anybody who has a SIP is making money, and that undertone of SIPs going down under and all is all, hogwash. I think this is here to stay. Equity as an asset class will remain the preferred choice. We are an expensive market. We will remain, but that is what bull markets are all about. And you have to be there to make money and enjoy the party. So I'm of the opinion the party is on, but more going to be large caps. So we have taken chips of the mid caps. We are putting it into large caps. 3 names which I can suggest. Firstly would be HDFC Life. HDFC Life. I think insurance is a no-brainer. These are stocks which are hitting new highs. Insurance and the gross monthly values of their increase in business. Their penetration, HDFC Life now has the access to Exide Lives, which they took over and in smaller areas. And I think that with yields on the softer side, they are going to be having very, very good, treasury income and so on. So HDFC Life is my top pick. I think 750 was the previous high. We are going there. Second would be Godrej Property. Now, Godrej Property is a proxy to gold and stocks hitting all-time highs. I mean, it's been 35 years for me in the market. I have not seen when gold, stocks and Bitcoin hit 20,000. So it's telling me real estate is the best proxy for fixed assets. And who better than Godrej Property? I am staying in DLF and in just closer to us, there is an area called the SPV, Special Economic Zone. He's launched a new product at 20,000 square foot. So you can imagine what he's looking at and where he's reaching. This is in Gurgaon. I am sure Godrej Properties going back to that 2,500 levels which it hit, maybe last year. Third would be L&T Technologies, LTTS. Their presence in defense and the other allied areas makes it a very, very good choice. This stock is hitting 50 to 100, and I would put these three pedigree names as in the serial of 1, 2, 3.
Right. Okay. Sanjeev, that's a fair point. But any pockets that you would say that, you know what, the rally has run its course, take some profits at least off the table?
Well, power. I don't want to chase power, and I don't want to. We have made, by the grace of God, a lot of money, and we want to preserve that. So I am more optimistic on the index, the bank Nifty, which has been a huge underperformer, and I'm very, very optimistic. Power is something I would take, lock, stock, and barrel off. Leave the rest of the 10% or 15% for someone else to make money. You sit out on that and power your own portfolio with large caps.
You mean the financiers, and Sanjeev, just want to clarify, PFC, REC, IREDA types?
The whole basket, NTPC, PFC, REC, read my lips. You have to be leaving something on the table. Don't chase these at these values. There is a frenzy over there. Be cautious. But it is not that they cannot run up more. I am of the opinion that it is a lot fair, but a large part of the fair and the overbought positions are there. And they are riding a huge boom which was missing for the last 10 years. I am not in a position to say that when they will top out. But if you leave something on the table, Aisha, you will always be happier and you made money. And there are enough stocks on the large cap which are giving me comfort, where I would be happier with a 12-14% return over the next few months. I don't want to chase 25% per month, but even lose some of my capital.
Interesting view. Kunal, I have to come to you and ask you, I know you follow the trend, but do you think it's time to now go a little cautious in the power names that Sanjeev highlighted?
Well, I will break it into two parts. The likes of PFC, REC, yes, of course, I think for these stocks, it warrants that, some sort of profit booking or maybe trailing stop loss kind of strategy is advisable over here. But for many of the other names, I was looking at the charts for Tata Power, Torrent Power, etc., these stocks are yet to get into that strong breakout mode. I think CESC is also another name which I think yesterday or last week managed to come back to that 100 plus range. So that's again an interesting breakout candidate from a longer term perspective. So I would probably break it into two parts. The ones which have already run up their course, yes, I think for them it makes a lot of sense to try and book part profits or trail stop losses. It depends on the buy prices of each individual investor. But I think for the other pocket, I think there's still a lot of opportunities where traders could continue to ride on to the trend.
Meantime, I wanted to get in your take, Sanjeev. I don't know if you track, but within the footwear space, Metro Brands has seen a pretty strong rally of late. Their strategy of premiumization clearly has been working, whereas some of the other peers within the space, say like a Bata or Relaxo, haven't quite been up to the mark. Does Metro stand out among the lot?
Yeah, good morning. Avan, firstly, just to clarify, I am also with Kunal on that. We own Tata Power and we will continue to stay with that. I meant the PSU side of the power basket. Just a clarification. Tata Power is one of our top bets. We think that their underperformance is now going to come out into as an outperformer. We have a target of 350 as a disclosure. This is in our portfolio. On Metro Brands, clearly, it is evident that the spending patterns, the type of frenzy you're seeing in Nykaa and Mama Earth and so on, you'd rather buy an asset which is going to be more durable. And Metro Brands has been very, very key in outperforming. Their presence in a large part of the metros and now smaller cities is gaining traction. And I think this is a very good consumer play which you have on consumption. So the stock has been on a tear since a long time, but declines would be a good opportunity to get in. However, don't chase value at this time. Since I said large part of the large caps are giving you a lot of comfort to be over there, particularly the banks and some of the insurance companies.
Fair enough. And what about your outlook then on some of these recent listings? Honasa, for instance, Iradia, some of the more muted ones as well that we saw. I mean, given that we're just on this topic, do you believe that some of the valuations here are justified, or the attention, or the kind of subscription figures that we've seen? What does the long-term story hold for a lot of these companies?
Look, Avan, 2-3 years back, they used to trade at 0.3, 0.4 time price to book. REC, PFC, and now IREDA gets a premium of almost 2 time price to book. Generally, historically, when PSU start to be 2 times price to book and they look the best bets, that is the time you should take money off the table. I am not chasing any of these. I think a large part of the rally is already built in. They've had a superb run. You enjoyed the party. Stay, try and look for other sectors which have enough valuation comfort. On your Mama Earth and others, now there is going to be the lock-in, and you'll have some of the others who will want to sell out. Today also there is a particular deal. So we are avoiding this space. This is a very competitive space. We have to wait for 2-3 more quarters. Let some of the old hands try and get out of this, because there will always be this frenzy for others to get out. And that's what the key has been in some of these newly listed stocks which are private equity owned. There is an entry and an exit for a lot of investors. So I am saying go with the tried and tested. You will make you'll have at least more security at not missing the bull run by buying some of the Nifty stocks rather than chase some of these new entrants which have already run up a lot. So caution on those side, but yes, fully bullish on the index and the index stocks.
Quite an interesting view there, Sanjeev. Always good to have you on the show. Thanks as always for taking the time out and joining in. Let me also welcome on board Rahul Chadda and figure out what he's making of the markets right now. Rahul, hi, morning, or shall I say evening? Are you in New York?
Yeah. So I'm joining this from New York. It's evening for me and morning for you all.
Yes, it is. And a party for you either which way, right? Because not just India is doing well, so are the US equity markets. But, the one point being, Rahul, when do you think FI participation is meaningfully going to come back to India? Because once that comes in, then we're looking at, further upside from these levels and a lot of upside, I guess.
Yeah, so I think the state election verdict should give some comfort to the FIs. So look, from an institutional perspective, there was always the risk of downside in the markets because the valuations were not so cheap. And to be fair, there are parts of the economy which are a bit slow, consumption particularly. So the state election verdict was clearly very positive in favor of the ruling party, and that gives expectations that we'll have policy continuity post the general elections also. And I think what we see is over 6-9 months, FIs would increase exposure to the large caps, particularly the banks.
Rahul, everybody is of the view that FIs will come back. What if they don't come back? I mean, there's no competition, they will come back.
Nikunj, it's a function of time. See, this is something we've discussed. What's happening also is globally, there is a slowdown. So you've got to look at the numbers. US was the strongest economy, but fourth quarter is going to be slow here also. Sitting here in New York, you get a good feel of what's happening in the US. Travel, tourism, eating out is doing well. Healthcare is doing well. Outside that, things have slowed quite a bit here. Europe is in deep recession. China has slowed down considerably. So if you look at parts of the world, things are a bit slow. And again, with US 10-year yields at where it was 1.5% plus, that reduces the attractiveness for equities. What we saw in the last 1 month was this relief rally because there was extreme pessimism and people thought that Fed would come and cut rates quickly. I think that is to be seen. How quickly does Fed cut rates, and what does it mean for markets in light of the growth slowdown?
Right. So, Rahul, what is it that you believe in particular, just keeping in mind the election outcome are likely to be some themes that would be beneficiaries in the coming months and the year ahead? Do you think that the capex related themes, or perhaps those that are related to the PSU space, are likely to be strong beneficiaries?
Absolutely. I think some of these themes, financials, capex related, would be themes one would look to buy. But I would rather say that rather than jump and buy now, I think over next 3-4 months, one will get entry points because globally the backdrop doesn't look very strong from an economic perspective or from a market performance perspective. So if the global markets are subdued or are down, it's highly unlikely that Indian markets would significantly go up. What would happen is they would do their job by not falling. And I think that's where some of these sectors which have done very well, industrials, and the capex themes you talked about, real estate, will provide good entry points. I mean, the dips would not be significant, but look, 5-10% lower. Some of these names would be good long opportunities.
Rahul, do you think it makes sense to, let's say, rotate 15, 20, 25% from mid and small cap stocks to large cap stocks now?
Absolutely. I mean, no doubt about that. I think what's happened is a lot of retail frenzies happened in mid and small caps. This is the other thing, Nikunj, we've discussed in the past. Investing is also about your downside protection. Look, the retail investors have made a lot more money than kind of a circumspect institutional investors like us. But what institutional investors do is do a bit of a downside protection also. So I think that is where it makes sense, having made so much money in these mid caps where valuations are expensive, growth is yet to rebound. It makes more sense to move to the large caps where the risk return is a lot more favorable and your downside is lower. Should globally there be an accident, look, you can protect your capital a lot more.
What, to your mind, will be the biggest moving part for 2024 apart from elections?
I think it is when the policy easing happen and more importantly when the economies respond. See, at the end of the day, it is the earnings which moves markets. Markets can preempt, anticipate, but if let's say the policy easing doesn't happen in which markets are expecting in June and Feds holds on to the rates till the end of the year and growth keeps on slowing down, then it is likely that the markets are headed down before they move up. So I think what is important is when do you get the broad-based growth recovery, both globally and within sectors, within or across sectors, I would say, in India also.
So Rahul, if you have to construct an India portfolio fresh now for next 3 years, how would you construct it?
Continue to like financials. See, financials being 1/3 of our portfolio. So within financials, let's say 25% banks, put 5-6% of insurance. We've had 7% real estate. One can be tactical about real estate, cut that a little bit, and then if you get a correction over next 3-6 months, add to that. So between real estate, financials, and insurance is 1/3 of the portfolio. Then would be industrial. So I think that is where one is looking at 10 to 12% goes to industrials, the infrastructure, the capex themes. Again, interesting bets would be metals. I mean, 6 months from now, I would be tempted to take a contrarian bet on metals. So look, we've seen these metal companies go for a significant capacity increase in India. Globally, also the sense is, look, if the economy's bottom and growth recovery improves, the realization should be higher for these companies. So those are names. Outside that, we've always liked the consumer discretionary plays, some of these select auto names or again Zomato, etc. So that's been consumers been about 20-25% of our portfolios historically.
Okay, fair enough. And wonder if you have, given a relook to some of the inflationary concerns, particularly playing out for the rural theme as well. How do you look at a bounce back within that space?
I think inflation is going to ease out. Already data is coming that goods inflation is eased out. What you're seeing is because of the cuts done by OPEC, oil is at these levels. So else oil could have been 20-30% lower. But because of the global demand weakness, the goods inflation which was there in 2020, 21, etc., is now slowly going away. So I don't think inflation would be significant concern. And as inflation somewhere eases, the pressure on consumer wallet, which we saw over the last 2 years, is going to ease. And that's where you'll see the revival of consumption, particularly in the rural parts of the economy, or I would say the bottom section of the economy or the population.
Rahul, I really appreciate your time. Thank you for joining us. By the way, what temperature is in New York now?
So we are at 5 degrees Celsius. I think it's going to snow in next coming days, but yeah, as we speak, it's somewhere around 5 degrees.
Manageable, actually. All right, appreciate your time. Thank you very much for joining us. 5 points higher for GIFT Nifty. Really? I mean, you have to also understand that there is a difference in implied open and there is a I think the implied open should change, right, Kunal? Yesterday we closed at what level?
I think 20,800.
Yesterday we closed at 20,000.
Futures, on futures.
Futures, right.
Yeah, approximately.
Which means if one looks at the current data right now, we are likely to close just a shade below 21,000.
Yeah. So we are up 10 or 12 points on an implied open. Because this, in the context of what's happening to the Asian markets, Nikkei is down 1.5%.
Yeah.
So I think in that regards, it's a decent flat opening.
You know, yesterday evening I saw GIFT Nifty of 100 points. Yesterday evening.
No, it was, I think, at peak, what I saw was 20,930, 920.
Okay, so maybe I remember it wrong then. Okay, now let's look at OMCs. That's where the real breakout moves happened. And 50% in just a matter of 4-5 weeks.
Correct.
Are they looking good for more?
Yeah, they're looking very good, in fact, Nikunj, because this is the sign of a classical change of trend. So I've always maintained this point that whenever the beta of a stock changes, and in fact, in this case, it's the entire sector, where the beta has changed significantly, that's a sign that a new trend is, brewing into the stock prices. So I think for the OMC names, specifically HPCL, BPCL, as well as IOC, I think all three of the stocks have shown a phenomenal recovery in terms of prices. The beta, which has been, I think, 0.5, 0.4 for these stocks, have now jumped up to 1.2 for these names, which is, quite rarity for these kind of stocks. And even in this last 2 months, 3 months of the price uptrend, where these stocks have rallied up 40%, 50% on an average, we've not seen any major correction. I think the best correction which had happened was in start of November, where these stocks corrected by 5% broadly from their short-term peaks. But I think post that, these stocks have run up another 20-25% further. So that itself tells you the kind of fiercity these stocks are showing in terms of trends.
All right, there you have it. That's the view coming in from Kunal, talking a little bit more about the trends that we're seeing as well within the entire OMC basket. But let's get in a top market perspective then and understand the outlook as well in the long haul. Madhu Kela, market veteran, gives us a sense as to how the recent state election results are impacting market sentiment. He also shares his views on top sectoral bets and talks about how public sector enterprises are actually driving the market rally. Listen in to this conversation.
The times for which we have been dreaming, like for last 25 years, that India will be at the front, and this all seems to be happening. 1 month back, we touched $4 trillion GDP. We touched $4 trillion of market cap. So all the right vibes, everything seems to be coming along. Now, if you are an investor, Aisha, and if you have a view of 2-3 months, that I don't know, right? In 2-3 months, anything could happen. But I think this state election is a bigger verdict really in favor of the ruling party, and it gives kind of a certainty for 2024 election significantly, that there will be continuation of the same party and the same policy given the election results which have come. And considering that inflation has been very stable, interest rates have been very stable, currency has been very stable, and there is no major volatility in any of the front, right? And the fiscal situation of the government is also very stable. So this all points towards more higher valuation than what we have seen in the past.
And that's the other thing, Madhu, like you rightly highlighted, that in events like this, fair value itself gets redefined, right? Then you sort of get a colored vision. You don't want to look at price multiples. You don't want to go by historic value of businesses. And there is that FOMO feeling which sets in that, why didn't I put in more money? I could have cherished the rally in so-and-so stock or the index also so much more. What do you have to say investors like that?
I think, I said the fact is that, markets are never ever in right place, right? Either they are significantly overvalued over a period of time, or they are undervalued. And who knows what the right valuation is? The only valuation parameter which we have is that of the past. The only yardstick which we have to say that the valuation today are expensive is the historic valuation. The other important point which I want to make, Aisha, that yes, markets are expensive, there is no doubt about it, from a 12-month perspective. But there are investors who are willing to pay, let's say, take 3 or 4 year view, specifically even the foreign investors who are willing to take 3-4 year view. if I couple that with the certainty of growth in India, right? So then market doesn't look that frothy or that expensive if I take a 3-4 year view. So I'm sure people who are joining the party late, either they will have to take higher risk or they will have to commit the money for a longer period of time. There is no other way to make money, right? So I'm sure people who are coming in today, they have to have a higher time frame to make reasonable return. That is what I would like to say.
Okay, what's your view on the public sector enterprises this year? Clearly have belonged to them. It's a major re-rating of sorts that has happened. Do you think more legs to this one as well, whether it's power, defense, railways, insurance as well, LIC for that matter?
I think public sector as a whole, there is a lot of potential. I'm sure we have spoken in your channel only a lot of times. They seem clearly the leader of this bull run or this leg of the bull run. You know, there is 30 lakh crore rupees or more wealth which has got created in public sector companies, all put together in last 3 years. Like, so some sector may consolidate because of the very steep price hike or very steep price hike in certain stocks. But I think there is a lot of value still in public sector companies, and you have to choose the right stock to be able to make money. And given that, you know, given that market is feeling there is certainty about the continuation of the same government, then you can imagine, you know, what will happen in the next 5 years. There could be possibility of large-scale disinvestment happen in the next term of this government. And if you consider all of that, and if you consider that the valuations are not yet anywhere expensive or euphoric in a lot of these companies, I would say stock specific is still money to be made in public sector companies.
Is the tactical strategy also to not look at market caps and be market cap agnostics, look at individual businesses? India has always been a stock pickers market. Yes, there are the themes that like PSUs, which, you know, sort of work as a blanket trade in exceptional categories. But largely we are a stock specific market and will remain so. And for all the naysayers or rather the doubters who are wondering how much more rally do the mid and small cap from here, they shouldn't be questioning such.
Aisha, this is the beauty of our market, that, you know, if you compare this market with any other emerging markets, we have really good breadth of sectors and we have really good breadth of companies here, right? And there are so many good, interesting businesses which have got listed and which are getting listed. You know, this level of activity in the IPO market, in the QIP market, we have not seen in the recent past. So you are absolutely right. Rather than saying that I want to buy or I don't want to buy mid-cap and small-cap companies, I think it is important to say that this is the company which I like and this is the company which I want to buy. And now it may well be from a small-cap sector, it may be well from mid-cap sector, it may be well from large-cap sector. So the right way to look at it is bottom-up, right way to look at it is do a lot of work, be sure about the promoter betting on, be sure about the business which you're betting on, and be sure that you're not paying very expensive valuation to enter such companies. And I think there are dime a dozen companies, even now, Aisha, which are available where money will be made in the next 3 years, if you have a view of that kind, in the mid and small sector companies also.
Without giving names, do highlight where are such pockets of hidden gems?
Yeah, I think we have discussed, Aisha, honestly, I hate to repeat, it is like a buffet. You eat what you want to eat, but don't overeat. That is the message. I think these companies are there. You can see it in select financial sector, select banks which are there, select infrastructure, select PSUs, which we discussed already, select manufacturing companies. So it is about, you know, being able to date, and it is about being able to be on top of the company which you are investing in.
All right, it's 9 a.m. Let's check in on the pre-open rates. Do remember that we've got a pretty shaky handover coming in from Wall Street as well as the Asian markets. So a little bit of a pause maybe until yesterday's ferocious move. But nonetheless, take a look at those pre-open rates indicating that 20,700 is on the Nifty with the Sensex up about 165 points. Time to get on those mid-cap calls. What is it that our chartists are eyeing as their top recommendations? Kunal?
Well, go with CSE as one of the stocks which yesterday gave a sign of a breakout. The stock was trading closer to 100, 103 odd mark for quite some time over the last 1 to 2 weeks. But I think yesterday we saw the stock breaking out of that 103, 104 barrier. So would look out for targets on the higher side close to 116. Stop loss for this trade, 105.
All right, Nooresh, let's get in your top trade.
So that would be a buy on Oil India, which has given a short-term breakout, as well as structurally the whole sector looks pretty interesting. So expecting this to make a short-term move towards the 360 plus mark, stop loss at 310.
Tell you what, we'll take a very short break. Be right back as we track the market open.
HOEC will be in focus today, and to get all that covered, let's go to Sharath.
For Hindustan Oil Exploration Company, the buzz in the street is that is expected to restart its operations in its well B80 in early 2024. Now, the company has already appointed Baker Hughes to solve the production related issues which are there for the well, and this company itself is a global offshore oil services company. Now, apart from this, also the company will be undertaking auctions from this well itself for its oils, which is coming up roughly 400,000 barrels of this total capacity, and they have stated that this oil sale will help in actually getting the clarity of the pricing as well as how the quality is coming from this oil. Apart from this, recently the company hired a new CFO also in the month of November, and the street is very bullish, especially when it comes to the reduction in debt and improvement in cash flows. But if you look at the stock prices, the stock has fallen by more than 30% from August highs, and the stock has been range bound over the last 3 months.
Let's look at the pre-open rates, and then Nooresh, is there a trade in the Nifty right at the open, because we are looking at about a 100-point gap up start?
So not really a trade on the Nifty if there's a further gap up, because the risk reward goes off. But what is interesting is the fact that the markets have given a breakout even on dollar terms as well. So the momentum could continue. It could just shift more stock specific. Banking as a sector should be a watch on dip. So if Bank Nifty comes back a little lower in the day, that would be a time to get into Bank Nifty.
What about the Bank Nifty? It's the other story. I mean, it's been an underperforming index which finally has broken out. Could it be the reverse at play for the Bank Nifty?
Yeah, so expecting Bank Nifty to take leadership. So that is what I'm saying. Dip during the day. Say if there's a gap up and then we again see a little bit of a fade off, you want to be getting into Bank Nifty, because that's at a new all-time high, and a lot of banking names are coming back really sharp in terms of outperformance. And what we've seen is the dollar flows changes meaningfully when we cross a new all-time high on the Nifty 50 USD. So yesterday was also the case wherein, say, we crossed 2021 highs on a dollar term basis. So going forward, banks could be the sector to be on all dips. So I would be looking out for a dip on Bank Nifty to buy rather than Nifty now.
Fair enough. Kunal, just curious to get in your take, because now and then we touch upon gold after hitting those new highs, come off a little bit. What's the outlook?
Yeah, it still remains positive or optimistic for both the asset classes, gold as well as silver. I think both of them have confirmed breakouts. Gold specifically, I think, has managed to break past about that 2100, 2076, I think was the multiple top range for gold, but I think that's taken out on a technical terms. So yes, the asset class has retraced, but then I believe that when such kind of structure they generally gets broken, we expect the trend to continue for for the asset class. Silver on the other hand is also heading towards a breakout. I think in dollar terms, it's way off from its all-time high levels. I think of $35, $37 or maybe more. But I think at current levels, I believe silver could be something to look out for, expecting at least another 10 to 15% up move on silver before it nears maybe a short-term top.
Okay, Some interesting ideas coming in there and across asset classes. But let's figure out what the index calls are. It's pretty much a unanimous consensus out there. Okay, actually not. Kunal is saying book part profits now. That's his Nifty call, whereas Nooresh continues to recommend a hold there. So that's the Nifty call this morning. What about the Nifty Bank? Again, Kunal is saying book part profits, whereas Nooresh continues to believe that one can go on holding their positions on the Nifty Bank and riding the move. And here's Nikunj's take on some stocks which are going to be in focus this morning.
You know, in a bull market, if you underperform and if the stock is not, if you don't deliver and the stock is cheap, the downside will get limited and restricted. For those, it is not like the darling of the market. It is a stock which, in a sense, has disappointed consistently in terms of delivery and in terms of performance. I mean, it's a Mahindra Group company where the entire group has changed complexion in terms of delivery. But Mahindra Financials, I think, has been an underperformer within the category and for the group per se. Now, we know that there is going to be change of guard soon. So maybe markets would give the stock a benefit of doubt. But, you know, at a time when everybody is going to rotate out of banks, NBFCs into banks now, I think NBFCs otherwise are expected to underperform. And I think the was there yesterday when Bajaj Finance, L&T Finance and India Bull Finance. So NBFC per se are likely to underperform. Within that, a weak stock I think will remain a ranked underperformer, but the downside would get only limited and restricted because of valuations and hope for a change of guard. I mean, they've not been able to fix the problems which they should have done it despite the lineage of Mahindra Group. Attractive cost of borrowing, great brand, great distribution, but the collection efficiency is poor, their disbursements are difficult, there's so much of volatility in the number that for a business which could have been a steady compounder actually has behaved like a commodity stock.
Okay, fair enough. That's the editor's take. But in the meantime, wanted to get in your thoughts then, Kunal, as to what you're doing with large cap IT.
Well, I think from current levels, I would be actually very bullish on the larger cap IT names. So, you know, in every sector or every phase of the market, there is bound to be one sector or a couple of sectors which tends to underperform. For example, in the last, I think, 600 points broadly, Bank Nifty 90 were two sectors which were underperforming. But I believe Bank Nifty has made a good comeback. The IT sector is the only one which is due to make a comeback. The mid-cap IT stocks have gone through a correction. Large-cap IT stocks like Infosys, TCS, HCL Tech, etc. These stocks have confirmed a minor breakout for themselves on the daily chart. So I would expect these stocks to try and come back to that tick of momentum. The risk reward is attractive into these stocks. Yes, there could be some bit of odd negative news flow, but then when we look at the chart patterns for these stocks, the recovery these stocks have shown broadly, larger cap IT names, I think that's where one should be looking to bet upon.
Right, okay, that's HCL Technologies in trade. Nooresh, as we step into the opening bell this morning, your top stock specific trade.
So I would continue to like Federal Bank, which should hit a new all-time high today at open. And that's a stock which has been a clear outperformer in the mid-cap banking space and consolidated well over the last few months. So the whole banking space looks interesting, but in that Federal Bank is an outperformer which could surprise on the upside.
Right. Kunal, large cap or mid cap banks? That's the debate now.
Anytime large cap banks at current levels, if you ask me, Nikunj.
Is that largely because of momentum or because of risk reward ratio?
So both. So momentum's come back into these stocks. Risk reward is very attractive for these names, and I think the market requires to move to higher levels the support of these larger cap names, which we've started to see for these stocks. So in these stocks are significantly off from their previous major highs, whether it's HDFC Bank, Kotak Bank, etc. So I think that's where one should be looking to play.
Minute 40 to go, and I guess the market we've had a monster Monday, a massive Monday, a magical Monday. Will it translate into a fall-off buying today? Well, logically, now global cues would be at play. What we saw yesterday was actually in isolation because of the local event. But theoretically, you have a case for FIs to come back. You have a case that where money will rotate out of large caps, small and mid cap stocks back into large cap stocks. That I think could be a trend. Even yesterday, the small cap index, there was a shade of underperformance. So when large cap stocks will come back, I mean, the general consensus view is that small and mid cap stocks are expensive, but large cap stocks are cheap. So that rotation rally, I think, really would be at play. And once performance comes back in large cap stocks, the compulsion to stay in mid and small cap stocks, I think, will automatically start, diminishing. So there is a law of diminishing probability, I think, which is there in small and mid cap stocks now.
Yeah, seems to be the case. Okay, headed in for the opening bell this morning. Of course, keep your eyes closely on HDFC Bank, on ICICI Bank, and Kotak, whether they continue to chug along the way they did yesterday, and really the might within the Nifty Bank, whether that can scale up higher and rub off on the index per se as well. In any case, we're looking at a print of 20,800. Let's see what the contribution list is looking like. Of course, yesterday you had some of the Adani Group names as well hold out very smartly. You had an Eicher Motors also, which surged about 7%. OMCs have been powering, all guns blazing. So BPCL was one such case in point. There was SBI as well holding out by 4%. And then, of course, L&T and ONGC as well have to be given due credit, Nikunj.
Well, it's the first rates, and let's see where markets open. Are we likely to see all of buying there? Well, let's see. You want to start with banks, big banks, PSUs and private banks combined, because that FI number just screams of that large cap buyers are back now. So HDFC Bank up another 15 rupees, ICICI Bank up another 11 rupees, and Axis Bank and IndusInd Bank are also giving it company. Now the PSU space, REC, PFC, the real poster boys of this year's real epic bull run. And REC flat, PFC not going anywhere. And let's look at OMCs now, oil marketing companies. What do we have there in terms of a mood point? Yesterday it was like a rising tide phenomenon, just about everything went higher. They're still very cheap, even though rally has been very strong. So let's see what happens there. HPCL, BPCL and IOC off to a good start. So there is no rara rally in any of the large cap stocks. Power looking slightly weak, FMCG looking okay, IT not contributing, and with the exception of Kotak Mahindra Bank, I think there is a lot of follow buying in at least large cap banks.
Okay, that's the take coming in right now on which way the tide is headed on the large caps at least. Taking a look at some of the other names which are going to be in focus this morning, and just take stock of what the OMCs have been up to, because that was where all the firepower was in trade yesterday as well, and seems like they're good to go in trade today too. So look at BPCL still holding up 1.5% as we speak right now. There's IOC as well, about 1.5% move. Look at IEX. The November volumes have seen an uptick of about 17.5%. Electricity volume as well is higher by 13%. That stock jumps up 1.5%. Bharat Forge, wherein the North America Class A truck orders have been the highest in 13 months, up 31% on a month-on-month basis, 0.7% higher for this stock. Bank of India, they're looking at a very sizable QIP this week as well. A range of 34,500 to 4,000 is being talked about, 1.6% higher for Bank of India as we speak right now. There is JSW Infrastructure as well, wherein JSW Dharampur Port is looking to acquire stake in the PNP Maritime for about 270 odd crore rupees. So look out for that. CAMS, great terrain. Remember, yesterday sold 19% at a price value of 27.66 in that sizable block deal that happened on CAMS yesterday. Today, the stock is holding up by about 3%. But I think more than these stock-specific movers, it's really about what the overall market is doing. And Kunal, not bad if we choose to consolidate today.
Absolutely. Consolidation at higher levels is always considered to be healthy for the markets. And I think with the kind of premium the indices are showing, both the Nifty and the Bank Nifty, as well as the higher support for these stocks, indicates that the markets are moving on to a higher level. So I think it's a good time where the index goes into a mild bit of an upward trend. But money stock specific, there is money flowing into the larger cap names. HDFC Bank is something which I would be bullish on from current levels. So it was a trade which I initiated yesterday. I would look to carry forward the trade even at current levels.
All right, clearly sticking with the large cap banks. Meantime, let's find out what Nooresh's strategy is. And Nooresh, are you also tilting toward financials as your first trade?
Yeah, so continue like financials. Federal Bank is the pick. The stock has hit a new all-time high, clearly an outperformer in the sector. So that is a stock which could go towards the 170, 180 mark.